16 Ways How the Rich Get Away with Paying Little to No Taxes. Hello, Penny investors. Welcome back to where future millionaires come to get inspired. This could be one of the most crucial videos you've ever come across. By the end of this piece, you'll gain insight into how to retain more of your money than ever before. Searching for this kind of information on the web often leads to advice about maximizing contributions, but we suspect you're seeking something more substantial. As Albert Einstein famously said, the hardest thing in the world to understand is the income tax. By the way, if you enjoy our videos, please hit that like and subscribe button, and turn on the notifications, so that you don't miss out on new videos. The wealthy employ costly accounting experts to help minimize their tax liabilities. Over the past decade, we've gained significant knowledge in this field, enabling our companies and personal wealth to grow rapidly. Be sure to jot down these insights because you never know when they'll come in handy. This isn't financial advice, but rather a collection of strategies that the rich use to expand their wealth, and we believe it's valuable for you to be aware of them too. Now, let's delve into the 16 ways rich people pay little to no taxes. Number 1. Invest all profits. Wealthy individuals often reinvest their business profits rather than withdrawing them as cash. This way, they can avoid immediate taxation since reinvested profits are not subject to taxes. This can involve various forms of reinvestment, such as expanding operations, launching new products or services, research and development, marketing, or acquiring additional assets. The key advantage of reinvesting profits is that these funds are not immediately subject to income tax. Number 2. Business ownership. They structure their personal expenses through their businesses. If an expense is necessary for the business's operation, it is often deductible. This includes purchasing personal items such as cars, gadgets, and even meals. When wealthy individuals own businesses, they can legally deduct these costs from their business income before calculating their taxable income. While it's essential that these expenses are genuinely related to the operation of the business, there are ways to legally incorporate personal items. Number 3. Change residency. Some rich people choose to reside in countries with low or no income tax, such as Monaco or the Bahamas. This relocation helps them legally avoid paying income taxes. This relocation can have significant tax benefits, but it also requires careful planning and adherence to legal requirements. To benefit from these tax-friendly jurisdictions, wealthy individuals must establish legal residency there. Number 4. International business. Companies like Facebook and Google establish subsidiaries in tax-friendly countries like Ireland. This allows them to shift profits offshore and reduce their tax burdens. Through the use of transfer pricing, these corporations allocate revenues and expenses among their subsidiaries. This practice allows them to shift profits to subsidiaries in low-tax jurisdictions and allocate expenses to higher tax jurisdictions, effectively reducing their overall tax liability. Number 5. Charitable donations. Wealthy individuals often create charitable foundations. Donating money or assets to these foundations not only serves a good cause but also offers tax deductions. When a donation is made to a qualified charitable organization, it can be eligible for a charitable tax deduction in many countries, including the United States. This deduction allows the donor to reduce their taxable income by the value of the donation, resulting in a lower tax liability. Number 6. Equity compensation. Rather than receiving traditional salaries, some affluent individuals opt for equity in their companies. This strategy allows them to defer taxes until they sell the equity. One of the primary advantages of equity compensation is the deferral of taxes. When individuals receive equity, they are not immediately taxed on the value of that equity. This deferral allows them to delay their tax liability until a later date. Number 7. Art investments. Buying art can be a tax-efficient investment. It allows for deductions as expenses, and if the art appreciates, donating it to a museum or foundation can yield significant tax deductions. Similar to other investments, when art appreciates in value, selling it may result in capital gains tax. However, the tax rate for collectibles like art may be lower than that for other assets, especially if the art has been held for an extended period. Number 8. Multiple nationalities. Some wealthy individuals choose not to have a primary home country, making it challenging for authorities to determine their tax obligations. Taxation is typically linked to an individual's legal residency or physical presence in a specific country. By avoiding long-term legal residency or continuous physical presence in a single country, individuals can complicate tax authorities' efforts to determine their tax obligations. Number 9. Gift money. Gifting assets to others, as long as they stay below specified thresholds, is non-taxable. For larger gifts, there are lifetime exemptions to consider. Gift tax rules typically include a non-taxable threshold, which means that individuals can gift a certain amount of money or assets to others without incurring gift tax. This threshold varies from country to country and can change over time due to tax laws and regulations. Number 10. Privacy coins. Cryptocurrencies like Monero and Zcash offer anonymity, making it difficult for tax authorities to track transactions. One common technique used by privacy coins is confidential transactions. In a confidential transaction, the transaction amount is encrypted, and only the sender and receiver have access to the private keys needed to decrypt and verify the transaction. Number 11. Asset-backed loans. Rather than selling assets, the wealthy borrow against them, leveraging their valuable holdings to access cash without triggering immediate tax consequences. When individuals sell appreciated assets, they may incur capital gains taxes on the profit earned from the sale. By taking out a loan against the asset, they postpone the tax event until a later date, which can provide tax deferral benefits. Number 12. Bankruptcy strategy. In certain cases, declaring bankruptcy can be a strategic move for the affluent. It allows them to discharge specific debts while protecting assets like homes and wages. The primary goal of bankruptcy is to alleviate the burden of overwhelming debts. In many cases, unsecured debts like credit card debt, medical bills, and personal loans can be discharged through bankruptcy. This means that these debts are legally forgiven, and creditors cannot pursue further collection efforts. Number 13. Yacht as second home. Some wealthy individuals claim their yachts as second homes to take advantage of more favorable tax rates. By designating a yacht as a second home, affluent individuals can benefit from more favorable tax rates on the yacht's ownership and maintenance costs. This can lead to substantial tax savings over time. Number 14. Trusts to avoid estate tax. By placing assets in trusts, they can ensure their heirs receive wealth without substantial estate taxes. Since the assets placed in the trust are no longer part of the individual's taxable estate, they are not subject to estate taxes upon the individual's death. This ensures that a more significant portion of the wealth is passed on to the chosen beneficiaries. Number 15. Depreciation deductions. Wealthy individuals depreciate assets like factories, equipment, and vehicles on paper. This decreases their taxable income, as long as depreciation exceeds actual cash income. When a wealthy individual or a business purchases an asset, they can deduct a portion of its cost as a depreciation expense on their tax return each year. This depreciation deduction reduces their taxable income for that year. Number 16. Blockchain and transparent taxation. With the rise of blockchain technology, some envision a future where taxpayers have more control over where their money goes, reducing inefficiencies and making the tax system more transparent. The vision behind using blockchain in taxation is to create a more transparent and efficient tax system. Taxpayers could have greater visibility into how their tax dollars are allocated and spent by governments. There you have it, guys. 16 ways how the rich get away with paying little to no taxes. We hope this video has not only enlightened you about the strategies employed by the rich but also inspired you to make informed financial decisions that will benefit you and your community. Thank you for watching. If you enjoy our videos, please hit that like and subscribe button, and turn on the notifications, so that you don't miss out on new videos. Where we go one, we go all.